Good morning, traders. This is Brad Matheny. Today is January 31st, the end of the month. Tomorrow is the 1st of February, and that is where my research suggests things could get a little bit more interesting with more volatility. Couple of very interesting things to talk about early this morning. Number one, the Reddit group, Wall Street Bets, has changed things recently. They've created a bit of a liquidity squeeze going on with a short squeeze targeting heavily shorted stocks and recently precious metals. I believe this is going to continue to create a potential for a flash crash or flash rally event, given the targeted stocks for a potential flash rally, and given 2x, 3x sector ETFs, where shifting assets could present a possibility for a real flash crash. Let me explain what happens. As the markets move in this manner, like GameStop did, let me try to take a look at Game here. I need you to understand that anything that moves in this manner from $5, $8 to $500 or more is going to be moving in, hundreds or thousands of multiples of standard deviation. Typically, most hedge funds and institutional funds operate with the concept of a 2 to 3 standard deviation range, and potentially test out for a 5 or 6 or 7 standard deviation variance. When things move in excess of, call it 100 or 200 or 500 standard deviation variance, this blows out risk and liquidity models. It really creates a real disturbance in the force, so to say. And this is what we're looking at, not just in various sectors, but across a number of ETFs. For example, I was reading what was it, ARKK, was reading an article about this hedge fund or this uh, uh, sector fund that was created by this ARK investment firm, and how the GameStop sector and the technology sectors for a lot of these stocks like Nokia and others, and remember, Reddit is targeting a wide variety of stocks that are shorted, biotech, innovation, technology, miners, things of this nature, metals. They're all essentially at some point being targeted. Anything that is heavily short, even retail, and other sectors. What ends up happening is like I said, the stocks end up in a short squeeze, which creates a liquidity trap for the shorts, causing a potential flash rally. But these sectors are designed to operate within standard parameters, and these types of shifts in price could send some real volatility waves through a lot of these sectors. So right now, we go back to the SPY. I want to just tell you that the next few weeks, possibly few months, could see a very big rotation. I've been telling everyone that I think that this year is going to be very much like 2018. So pay attention. I'll draw a little box here to show you 2018. This is basically what happened 2018, right here. And you can see, I'm going to move my box a little lower here. You can see here that what we have is a real breakout sideways range taking place right here. Rallied up into January, stalled at the peak near January, rolled back down February, March, double bottom, set up, a bit of a recovery, and then a very deep rotation near the end of the year. I kind of think that this is what's happening this year. We've seen this big rally. I think we might see a big breakout move down over here, possibly down into the 340 range on the SPY if the volatility trap sets up and the liquidity trap sets up as I'm expecting. Then we'll see it kind of die down, maybe a couple of smaller attempts. It'll continue to wane out, and then potentially a more massive volatility trap if the groups, Reddit and others, continue to target shorted stocks, heavily shorted stocks, or potentially overvalued sectors. So we're in this area here where we need to play very cautiously. We could get some very volatile trends. The SPY has come back up off of this long-term channel and stalled again. The last couple of days have been very interesting in the sense of the deeper rotation with the gapping here, stall, gap down again. This is very big, and we'll need to see how it continues to play out in the sense that this could be a shift. And what I'm talking about here is traders may be shifting capital away from risk, anticipating potential concerns. And it really boils down to we get below this yellow line here, let's call it 358, and we could potentially move back down into this 340, 335 level. Understand that when we get below this level, if we get below, call it the 320 level, then essentially all bets are off. At that point, we are now targeting lows that could potentially equal this COVID low down around 218. This would require a very deep downside move. Understand that it may take many weeks to get there. This is the current week. We have one more week here, and then we end this Fibonacci price amplitude arc right here. But again, breaking through this yellow support channel, breaking through this red and blue support channel at 340, 335, puts us at the last low right over here, 320. And anything below that could put us in a very deep correction, possibly seeing a very deep washout pattern, something that comes deeply down into this area, maybe down into this area, stalls, and then comes back up, stalls, rotates down, and then attempts to find some additional support and move higher. So let's go ahead and take a look at the basic markets. We're going to go over the custom index charts right now. This is the FANG index. You can see that it's rotating back near this upper channel again. This is a 2x standard deviation range from a pitchfork that's been drawn back over here. This is the pitchfork channel. So you understand that this is basically in the upper 2x standard deviation range. It is beginning to move lower. This is indicating that the trend is weakened considerably. We'll see how it plays out. It could break, if it breaks these channels here, this low, we could see a deeper downside move. And that's kind of what I'm expecting right now, not knowing how this Reddit group is going to play out their hand. The U.S. stock market index rolled deeper. It's come down off of this channel. This has rallied much further than I expected. I thought that this was going to be the real resistance level here, but it carried out further, got up into this area, and has come back down. You can see we don't have any confirmation yet here. That's what we're really looking for, is confirmation. You'll see my trending systems haven't rotated into bearish yet. We have here the smart cash index really collapsed from these peaks. It got up above this 0.618. It's now moving back down below this middle channel. This is the upward standard deviation channel, pitchfork. It's getting below this channel. If it continues to break, we've got to watch down at this area for support. And again, this is back into October, November lows. If it gets below this level, then we are looking at a much deeper breakdown at this point. So right now we've got a very good indication that things have rolled to the negative side. Metals index, if you're not familiar, Reddit is already targeting silver as one of the most heavily shorted equities or commodities on the planet. It could become a very explosive move. When I say explosive, silver related stocks, gold included, could see a rally of in excess of 80 to 200%, depending on how things play out and how deeply the liquidity trap sets up. This would put the metals index very likely at 550, 600 or higher on a big breakout move. We'll see how it plays out. Okay, remember, this is mostly gold with a little silver in here. So if silver moves dramatically, gold will tag along like a little brother, so to say. Silver would move probably 3 to 4 times faster than gold, just FYI. Okay, the volatility index broke down very hard. This is because of the VIX increase over the last couple of days. And again, this is something I need you to understand. As volatility shoots up and skyrockets, as I mentioned to you at the very beginning, when things move one or two or three standard deviations in channels, no big deal. Models are designed to pretty much expect that. When they move 10, 15, 20 times standard deviation, whoa, this is really messing things up. It's just kind of like a rogue wave. Think of it as normal waves, 3 to 5 feet. Now I'm out in California. I'm used to the Pacific Ocean and the waves. So 3 to 5 feet, no big deal. That's fine. Things get to maybe 8 to 10, 12 feet. Okay, got to take a little caution. That's kind of 1, 2, or 3x standard deviation. But when things go to 60 feet, okay, wait a minute. This is really wild. And potentially what happened over in GameStop is more along the lines of a 250-foot wave. It's really massive compared to normal. So this is what we're looking at here, and it will start to blow out models. It will start to blow out risk levels. It will create a big problem for liquidity, and it will create, some real issues down the road if it continues. So again, this volatility index is rotating lower. It's back down near this lower channel. If it breaks below this lower channel, we're looking at potentially a fairly deep extended downtrend. We would want to watch for this level here, the lows that took place back in November. Again, this is a critical level. If it could come down, stall near this 6 level, and try to recover back up over a couple of weeks potentially. But again, this is this is unprecedented what's happening right now. It really is something that may be a sign of an excess phase blow off. It may be a really big blow off peak in the markets if it sets up and does what I think it could do. So we need to kind of see how this is going to play out, whether there's any stability, how the stability comes to play. And like I said, metals and silver could be the big winner out of this. You could see a 5 year rally in silver and gold because of this. You could see silver up at 70, $80. You could see gold up at 4,500, 5,500 and climbing, and it could go for another 4 or 5 years. Okay, next, valuations index. Valuations index is stalled. It's broke down. This is an indication that essentially we're in a depreciation phase, and this is partly because of the movement of the treasury yields in the U.S. dollar, as well as the downside move in the major markets. We don't have any new breakdown yet. It's stalling in this little flagging pattern right over here. I expect it to probably break down this week into new lows, possibly into this 240 range. Could get even deeper depending on how things move. So again, pay attention. Things could rotate into a new downside trend or sideways trend. Things could become extremely volatile. I need you to be aware of it. This is last week's. This is the new scanner. We've got a bit of new warnings here. You can see here we've got a lot of warnings, bearish distribution, warning, warning, warning. We've got a lot of things moving into the negative territory as far as trending, even though they're still long. This can happen. This is the trend indicator. This is what I use to rank these signals. And what you're seeing here, ladies and gentlemen, is essentially that we have a series of long trades that are still playing out, that are still active, that have hit numbers of targets. But you can see here that a lot of them have moved into distribution and warning, indicating that trends have stalled, trends have moved sideways. And a lot of these have come after already seeing some pretty good percentages. So look here, 17%, 15%, 18%. Here's one 23% down near the bottom, the XLI, it looks like. Long and short of it is things are starting to move a bit sideways. We are likely going to get over the next couple of weeks a number of new triggers. You can see through the number of bars in trade right here, this green and red column. We've been in these trades for many, many weeks. These are weeks. This is run on a weekly chart basis. So you can see here we've been 15, 30, 20, whatever. We don't have very many new signals. We have one new signal right here in GDX that was 2 weeks ago off the downward rotation. This is likely to change fairly quickly if things do what I expect them to do. You can see here that we're basically, if things rotate, we're going to start to see some real rotation in these trends. We're going to see things flatten out and regenerate new triggers. So it could be really exciting getting a bunch of new triggers over here. Okay, let's go back to these systems and go through our basic charts. Right now, the ES is still bullish long term, bullish daily. The NQ is still bullish weekly and bullish daily. We're seeing some rotation here. The YM is bullish weekly and bullish daily. So again, nothing has changed on the longer term trends yet. Gold is still negative daily, bearish daily, bullish weekly. And this again could be a very big breakout trend setting up around this support level. Support right now is 1780, roughly 1775. Silver has shown some real potential here. Set up a nice little base over here. I moved this line off of these lows. These are breakout patterns waiting to confirm. We've had a big breakout over here. We saw a failed breakout right here. Silver could again on a really big breakout, and it's maybe tough for you guys to see, but this created a very big cup and handle formation way back over here. We had this $50 high. And what's happened here, ladies and gentlemen, is this is a peak, a very deep, slow cup formation. Now we have a little handle formation. The next move potentially is going to target 45 to 50 back up to these highs. And if it really does squeeze, 50 is just the start. Literally, silver could rally above 100, $125 on an extreme short squeeze, kind of like what GameStop did. Imagine this is $4 right here, or this is $4, this is $12 in GameStop, and GameStop reached a peak of 540 bucks. So understand that silver could, trade up in the 200, 250, $300 range potentially. I'm not saying it's going to happen. I'm saying that if the short squeeze does take place, this could be an explosive move in metals. Crude oil is stalling out. You can see it here. It's moved a bit sideways. Let's move back over here. It is still bullish on the weekly, bullish on the daily. It's kind of flagged out over here, gone sideways. We'll see how this thing plays out with the economy going forward. Could very well still continue to move higher, back up above 60, 64, and retest these highs again. But right now it is stalling out. It doesn't seem to have much trend. Natural gas, as you're well aware, I keep telling you, I really do like this trade. I am in UNG right now, waiting and setting to see what's happening. I do like it. I do like a move back up above 350 or 4. I think that the winter is going to be extremely cold and demand for natural gas could spike. I do like this little rotation, this inverted head and shoulders. Here's the left shoulder. Here's the lower head. Here's the right shoulder. We'll just see how it plays out. Again, this is my personal opinion. I like this trade. And I've shown you many times before how in the past you can see in January, February, March, we see some pretty good moves. So here's December 10, a pretty good move. Here's December 8, a pretty good move. Now remember, this is a pretty big move in a downtrend in the market. This was again a pretty big move here in 2006. Very big move in really almost all year. Look back over here. It started back in January and then just stalled and then took off. I think we're setting up for a pretty good move again. And I really think we could see something above 550 or 6, but time will tell. I don't know yet. Lastly, let's go to the transportation index. The transportation index has started to really break lower. You can see it is still bullish. We have support down here around 980. Let's call it 99.50. And you can see here it's dancing around the daily support level on my rotational modeling system. Still bullish though. This could flip depending on how the market sets up and how the rotational modeling system sets up. A deep downside move could turn this into red fairly quickly. And this is really the first sign that we have some weakness here. Let's take a look at some of the other sectors here. Let's take a look at the mid cap. See, it's obviously setting up quite high. bullish, bullish. Let's look at the XLF, which is the financial sector. Still bullish, bullish, a little yellow here. I'm looking to see if we have anything that combines or looks like the transportation index. IYT is the transportation index ETF. You can see it's gone pink. Hasn't gone red yet, ladies and gentlemen, but it's gone pink. Let's try SSO. Nope, still green, still green. URTY. This is the Russell, still green, still green. And let's see what else I have in my list here. Let's take a look at bonds. Bonds are green weekly, meaning bullish weekly, bearish daily, setting up a decent bottom here. If the market corrects, bonds could be a pretty good move as well to the upside, possibly back into this 158, 159 level. Okay, so that's it. I'm going to just give you a word of warning. The next couple of weeks could be really interesting. You could see a lot of volatility. It's going to set up a lot of great trends. I will tell you this. If you wanted to take a proper stance, my advice would be to liquidate some profits, pull some cash out, sit on the sidelines. This is going to create a lot of opportunity for us in the next few weeks and months, meaning a lot of sectors are going to roll over potentially. A lot of new triggers are going to set up. There is some opportunity if you've been accumulating metals, silver and gold. Be very happy. You might watch those things rally up 4, 5, 6, 700% or more. If you're trying to get into some of these trades, stay cautious and understand that there is opportunity in what's going on in Reddit and AMC and some of the others. But you just have to know how to play them. Like I said, if you're gonna bet the farm on something, you might as well be a little bit cautious about how things are. For example, if you were to dump 10 grand into AMC, and let me take a look at AMC real quick back over here. AMC. So hypothetically, if you were to dump 10 grand into AMC after this big rally, which by the way, I was buying down in here because I thought Disney or Netflix was going to take them over. And I ended up getting out up here at 14, 15, thinking, hey, that's good enough. I'm good. And then I got back in down here around 11. And I'm basically looking at it like, okay, next week, if it opens in the 20, 25 range, I'm going to sell enough to cover my entry and then let the rest of it ride. And that's what I would advise many of you to do. If you're going to chase these things, get in with whatever you feel is comfortable. Don't bet the farm. But as soon as you get to a point where you can cover your entry and take a little profit off and the rest of it's just gravy, then trade it however you want. If you want to ride it out for the 3 weeks and shoot for the $400 target, I'm not going to tell you no. It's up to you. You make the discretionary call. It's just that I know that I feel safer once I pull my initial capital back out and let the rest of it rally as call it house money. So there we go. This could be a very good week. We're going to sit down and see what happens. Okay, talk to you later.